Going to start now. Recording in progress. Who's got news for me today? So is Noah here? Hi, give a shout. I'm looking at it. All right, what's this article about?
So it's pretty much about they came out with some consumer price index numbers that are a lot higher than people expected. And they kind of speculated that the Fed might raise interest rates, but they said that they have a meeting coming up and some of the people on the Fed board have already said they're not interested in doing that. And then it also talked a little bit about how the White House is trying to get some legislation going to combat the rise in inflation. And that's pretty much it.
Okay, what kind of legislation are they talking about? Because I've heard some whispers about this. What about price controls? Say anything about price controls? High inflation's out there though, right?
Yeah.
Which goods and services are we observing higher prices in? I think somebody did a deconstruction of this and found that higher prices for cars makes up for a lot of the increase in inflation. So do I care? Not as much as I would have otherwise. I care a little bit less. Means that if you've got an old car right now, well, it's a good time to sell it, right? I'm in the midst of trying to sell my car. Actually, I need to call my mechanic. Dude, can you sell my car already, please? But okay. So yeah, inflation is an issue. Ryan Sweet, how do you get that name? It's like both Chad and early 90s Christian alternative rock at the same time. Oh God, snow. Cut it out. I assigned chapters 6 and 19 this week, and so far I've almost gotten to chapter 19. That's not good. That means that next week I'm gonna have to really struggle through chapter 6 and get caught up on chapter 6. However, it does not mean that I'm changing due dates, because that's a hassle. So that means you have to read the textbook, which I've said before. Yes.
I had a question about the GDP project.
The GDP assignment?
Yeah.
Okay.
So for the graph that has the natural log of real GDP, can you explain what's on the y-axis and what that means a little more?
Ooh. Were you here Wednesday?
Yes.
And so I didn't do a good enough job then, huh? My fault.
I need some more clarity.
Now the thing is on Excel, right? If you take the natural log in a column and create a new column, then what you'll get as a number out of that, right, is not at all related to the GDP calculation, right? It's related, but it's the natural log of it, right? And so what you'll get on the axis is 2, 3, 4, 5, 6. Which is the natural log of whatever GDP is, or whatever measure you're taking, right? That's not what we want. We want this axis, right? And this is years still. And we want this axis to say, a 10,000, 100,000, or something like that. We want it to go up logarithmically on the actual axis. So I think that there's a video, I don't think there's not, that shows you how to change in Excel the axis. So you go to Format, Axis, and change it to natural log. And the closest you can actually get is choosing a natural log of 3, I think. But it still sort of accomplishes the same goal. Has anybody done this yet? Yes, did it work? It worked? Was it hard to find? It was hard for me to find when I didn't know how to do it. I asked everybody in the department, hey, in Excel, how do you create, a graph with the natural log on the y-axis? They're like, I don't know. Right? And enough time on YouTube and Google helped me to find it.
Is there a video of that then?
Well, there was.
Okay.
Oh, that'll help.
Was there?
I haven't finished chapter 19, so maybe I just won't. Here, share. Let's go to Excel. No, that's your reads. Downloads.
Okay. Tutorial link, it shows them. Okay,
Does it show how to do it in the tutorial?
I must not have seen it.
So,
Thank you.
if you create a graph. I'm just gonna go here and just pick, insert. Scatter plot. And I'm gonna select the data. Take X values are this column. And Y values are this column. That's completely arbitrary. All right, okay. And I get the graph, here's my graph.
There's no graph.
Thank you. Share. Share.
I mean, I already turned it
Okay, and then I zoom in on my graph a little bit here. Here's my graph. I've just grabbed some random numbers, right? I'll right click on this axis and I'll hit format axis. And then I will, so many things on here. Hit this logarithmic scale button here. You see that? You see that on that screen up there? Hit that logarithmic scale and hit, I think you hit base 3, works good. Enter. And see what it did to the graph? Right. It actually made it linear instead of, it made it curved from linear because it started out linear, but notice it goes 1, 3, 9, 27, 81. It increases by factor of 3 every time. Right, and so you can choose how to do that. Okay, and what you're going to find is that the logarithmic scale that you find in your GDP graph, the curved graph that you see in your GDP graph, will become like a straight line for each country and the state.
So what goes on the y-axis? Like, what's the title for that? Just the log of GDP?
No, it will actually be GDP. It'll be actually the number. Because notice, like I've incorporated the log into the axis, into the scale of the axis. So you're getting the real numbers there, instead of having weird numbers on this axis. Does that make sense now?
Yes.
Okay, good.
And we're just taking the natural log of real GDP. Is that what we're taking?
You can either do real GDP or real GDP per capita or both. I think real GDP per capita is most important in the long run.
Okay.
One of you emailed me that that I got the state country pair wrong for some of them. Who was that? Were you in this room? No. The I confused Wisconsin and Minnesota because I'm not from the Midwest.
Oh.
So that happens. You make mistakes. We had dealt with Modigliani's life cycle hypothesis, where we borrowed here, we pay back what we borrowed. So we're borrowing for a certain season. This is our lifetime consumption, right? And then we pay back what we borrowed, and then we save for the future, right? And we save for the future, and then we retire, and then we die. This is the Modigliani model. Friedman had a similar way of doing this, but he said that income is composed of two different components. Oops. YP and YT. This is permanent income, this is temporary income. Or transitory income. Right? And if you have a change in your permanent income, right, then that is more likely to affect your consumption today than a change in your transitory income. Which is sort of the same idea that Vivian was getting at, but he didn't formalize it in the same way. So the permanent income hypothesis here changes the consumption function to see consumption is some proportion of your permanent income primarily, and that your transitory income doesn't really influence your consumption decision. It just puts that money into savings. Maybe a little portion of it, goes towards changing your consumption today. And by going into wealth, but Friedman didn't have like a wealth component to his hypothesis here. Now, this hypothesis means that your average propensity to consume is equal to C divided by Y. And if we take this, then it would be alpha of YP over Y. So then, if high income households have higher transitory income than lower income households, then the average propensity to consume will be lower in high income households. So if the transitory portion, right, is affecting higher incomes more, right, then the average propensity to consume for high income households is likely to remain more stable than for low income households. Over the long run, income variation is due mainly, if not solely, to variation in permanent income, which implies that your average propensity to consume is relatively stable, not greatly or easily affected. The data for high income households shows that the high income is mostly transitory income. So then high income shows a lower average propensity to consume. Now, what do we really mean by high income here? Who are the most high income people? A lot of the more high income people in any given year, right, are people who are paid on commission. And commission is highly transitory. It shifts a lot from year to year. You can be very, very successful year after year after year, and then it becomes less transitory. That becomes a subjective decision about how much of your commission to treat as permanent. Those who I know who receive a lot of their compensation in terms of commissions tend to live off of their renewals from previous sales and tend to treat commissions for this year as transitory. They don't include that in their consumption decision making. They put that into savings, right? And use it for times when things get bad. Years of high income are typically people experiencing a transitory boom. Over long periods, most of the variation so that's in the short run. Most of the variation is in transitory income, so the average propensity to consume is relatively constant. However, over very, very long periods of time, most of the differences in income are related to the permanent income. So if you look at 10-year periods, right, then permanent income has a stronger impact. Okay, so there's Friedman's permanent income hypothesis. Next, from Friedman, we go to the work of Robert Hall, right, who talks about what's called the random walk. And you may remember this from your intro macro course having to do with investments. Hall said that expectations matter and that people mostly make rational expectations. People will use all of the information that's available to them when making a decision, depending upon the cost of getting that information. They're rational about how much information they seek to acquire before making a decision as well. The first implication of this is that, if you look at stocks in the stock market, if you think that you know something about a firm that should explain that would predict that the stock value of that firm is going to go up in the future, you're probably already too late. Right? Somebody else has probably already got that information, and if they have, then they probably bought that stock already. But their very buying of that stock causes the price of the stock to go up, such that the value of that new information is already baked into the value of that stock. If you really have information before anybody else does, you can make a ton of money. But in the meantime, the fact that you've made money is not just, oh, you got, a windfall. What you've actually done is you've provided information to the rest of the market about where they should be investing their money. You've generated information that's useful to everybody else. This information though, if it really is novel information, will get quickly baked into the prices. The idea then is that unless you're paying very, very close attention, you probably can't outperform the market. You probably can't outperform the rest of the people who are investing in stocks. So then the typical recommended strategy for investment by economists is to buy spiders, right? To buy index funds. Buy and hold and just let it be. Because you could be doing something useful with your time instead of paying very, very close attention to the stock market and being late. Instead, you probably go make something or do something, or earn something, right? And then invest in the overall stock market, fully diversifying to the entire market. And evidence has been that returns on index funds, after also including the cost of paying for the active manager of your portfolio, tend to be greater than actively managed portfolios. So you end up doing a little bit better than an actively managed mutual fund, or even something more particular. Now, there are venture capitalists out there, they're picking and choosing, right? But they're typically involved at the very early stages where a firm might not even be on the market yet, right? So one thing that's happening a lot right now, very, very big deal in financial markets right now, is to take a firm that isn't public, and that the cost of it going public would be very, very expensive. And so what is done is that a firm that is already public will buy up the privately held company, right? Instead of going through the IPO process. They'll just, the firm that's already publicly traded will buy the privately held firm, and then the firm basically is public by default. There's a lot of activity in financial markets right there right now, in all different sectors, yes? No? Anybody know anything about this? Are you hearing about this from your finance professors? Yes? Are they talking? What you said you know something about this?
I was gonna ask a question.
Go ahead.
Is that like a spec?
That's exactly what I'm talking about.
Okay.
So how much are you hearing about this in finance?
I heard about it with Churchill Capital and Lucid.
Okay. I don't know anything about that.
Oh, well, it's like, Lucid's like the new EV car coming out.
Nope.
Oh, well, I think a bank like bought them or something like that.
Okay.
Like
So
already like you said, publicly traded like bank bought Lucid, and then now I guess like that was them going public.
That is them going public. You said them going through like a normal IPO process, right? Now, in terms of consumption, what does this mean? Well, the value of your portfolio has to do with your wealth, and if you're consuming some out of your wealth, then that matters. Hall said that similar to investment, changes in consumption don't happen unless they are done in response to some exogenous shock of new information. That shock is typically unpredictable. So something might happen. I don't know. Maybe home prices in a certain neighborhood go way up. You didn't expect that to happen. It was a random shock that occurred, but now you have a lot more wealth, and that factors into your consumption habits. Are you with me? And his point is that it follows a random walk. There's no way of knowing ahead of time. Any information that is available is already baked into whatever prices exist. So there's no way of predicting what to do in the future. For policy, what does this mean? It means that in order for policy to be effective, in order for a change in monetary or fiscal policy to be effective, it has to be done in such a way that it's not expected. So the government wants to increase aggregate demand, and it seems to think that increasing the quantity supply of money will boost aggregate demand, so it shocks the public with an increase in the inflation rate. But if inflation is expected to go up, then consumers have already changed their behavior in anticipation of that shock. Is the government going to increase government spending? If it's, as soon as it becomes announced that the government is going to do that, that becomes baked into the decisions of people. So this is all part of what is called the rational expectations revolution in macroeconomics. Rational expectations. However, now we're talking about having a policy that will shock the economy and achieve its goals. However, if it's done in an unexpected way, in an unannounced way, can it actually be democratic? Right? Do we democratically decide to allow the Fed to shock us with greater inflation rates? Is there a democratic process? If it's a democratic process, then we already know that it's going to happen, and that shock can't surprise us and not follow around and walk, so it won't be effective. So can we have both a truly democratic approach to macroeconomic policy and one where interventions are actually effective at achieving the goals of those institutions? It becomes very difficult. Very, very difficult to maintain both at the same time. In order to study this, you don't look at the date that the policy actually goes into effect, you look at the date that the policy was announced. So there are event study types of financial models that exist out there that look at not necessarily when a policy actually went into effect, but when it was announced. I relate this to some of the work that I'm trying to do on abolition of slavery in Great Britain. So they wanted to end slavery in Great Britain. How are they going to do it? They're just going to emancipate all of the slaves in the Caribbean? No, a lot of people have a lot of money invested. And they didn't want to lose all their money. It wouldn't pass in the democratic process. Those people all be made worse off. How are we going to get it to pass? Well, we're going to have to compensate the slave owners. We're going to have to pay them to free the slaves. Okay? Well, as soon as you announce that we're going to pay off the slave owners, what happens to the value of a slave? It goes up. Now, the discussions about compensating the slave owners were done by members of parliament in parliament, and a conversation there. And it was kept secret from the public. The public still was hoping for just an absolute emancipation, just total freedom, and no buyout. But the members of parliament were discussing it and decided that there would be a buyout. If you're a member of parliament, and you know that the public's expectation is that the slaves are just going to be emancipated, but you know that the slave owners are going to be compensated, what might you do?
Buy slaves?
You might buy slaves, because the value is going to go up once the compensation scheme becomes publicly known. And most of the slaves were not held by individuals, they were held by plantations that were public shares, held in common by public shares. And it turns out that the data about who got paid when emancipation or when abolition actually passed, a lot of the people who got paid were members of parliament. Should not be in the least bit surprising, at least not to somebody who understands a little bit of political economy. Wait a minute, that makes sense. As a matter of fact, abolition might not have been able to pass, it might not have been politically expedient unless both there was a compensation scheme and the members of parliament were able to take advantage of it. Otherwise, you might not ever have gotten it. That's ugly, Snow. Yes, that's very ugly. It's also the real world. We have this Cobb Douglas production function. So what I want to do, right, is I want to go and look at the prices of the shares of these plantations before compensation becomes publicly known and after, and see if I can follow who owned the shares and whether there was a major buy-in by members of parliament or people that they knew. Whether there was a big insider trading activity that occurred where, the members of parliament and the Martha Stewarts got together to agree to free Snoop. Okay. How close am I walking to the edge here, folks? I'd have to go find a bunch of old newspapers to find those prices though. So I hope you go to England someday to do that. We got our old friend, the continental correction portion. By the way, in chapter 19, or I'm sorry, chapter 20, which is it's chapter 19 in the old edition. Chapter 20, we're dealing with a lot of variables that actually get introduced somewhere between chapter 7 and chapter 20 that like are new to you because we skipped a bunch of chapters first. So you're getting exposed to these variables and these ideas a little bit out of order. So you'll even read in the text, like as we discussed in chapter 12, you're like, no, I didn't read chapter 12. Right? We're gonna get to it. We're gonna get to it. From this basic model, we understand that the marginal productivity of capital, the first derivative there is alpha times A L over K, 1 minus alpha. We also know that in equilibrium, the rental price of capital is equal to R over P, which is also equal to this whole thing. So what does this tell us? If capital stock decreases, then the price of capital goes up. The rental price of capital goes up. If the quantity of labor goes up, then the price of capital will go up. If technological improvement increases, then the price of capital, the real price of capital will go up. The cost of capital, right? You have to earn R over P when you rent out your capital. That's your revenue. But the costs are the interest that you pay on capital. Let's put I P to K. Okay. So how much what does it cost to borrow to buy a piece of capital? That's your interest cost. And that's going to end up being really close to the savings rate. Then there is a change in the market value of capital that can happen exogenously. If the price of capital goes up randomly, right, then that's going to cost you more as the owner of capital. So that's basically your resale value of capital. And then your capital can depreciate. And we use this letter D to talk about the depreciation of capital. So then the total cost of capital is the interest that you're paying for buying the capital minus some exogenous change in the value of that capital plus the rate at which that capital is depreciating. We can collect terms. Okay. And if the price of capital is changing at the same rate as everything else in the economy, then this term is the same as inflation. And we know that I minus pi, the nominal interest rate, minus the inflation rate is the real interest rate. So then we can gather all of this together and get the cost of capital is equal to P of K times R plus the real interest rate plus the rate of depreciation. Now, we're going to see these terms a lot in chapter 8 and 9 when we talk about economic growth. So we're familiarizing ourselves with some terms now. The real cost of capital has to do with the rental, the price of capital over the general level of prices. Putting the general price level denominator, we get the general price that we control for inflation We get this as our cost of capital. Where are you going with this? No, I'm not quite sure. We'll get there in a minute. The revenue that you earn from owning capital is the rental price of capital divided by P. The real cost is this that I just walked through. So then your profits for owning capital is your revenue minus your costs. And we remember that this is equal to our marginal productivity of capital. So profit is marginal productivity of capital minus K over P times R plus del. So then how much capital do you want to invest? What is your net investment? You're trying to earn profits. How much capital are you going to invest? You're going to buy capital until your profit is equal to zero. You're going to continue to buy capital up to the point where your profits are zero. So what's your change in investment, in the amount of capital that you own? That's going to be your investment, right? And that's going to be determined by this term. This is a function, not a multiplication. The brackets are describing a function of investment. And since we're talking about macro, what we used to bring things into equilibrium in the classical model from the earlier chapters was the interest rate, time price of money. And so we focus on the interest rate, and we build a graphical or a geometrical model that looks like this. That is our demand for investment. Our demand for investment is downward sloping. Why? Because the sign right there is negative. What happens if the interest rate falls? Everything else held constant. If the interest rate was this, and then the interest rate falls, everything else held constant, what happens? The amount of investment increases. So that's kind of obvious, right? By investment, again, here, what I'm talking about is purchase of new capital and equipment. I'm not talking about buying stocks, right? If we wanted to relate this to the stock market, what this would look like is issuing of more shares. Like more investment actually happening of real stuff. And in order to buy real stuff, you need to issue more shares. We're talking about the actual buying of things that are productive in the real world. When the interest rate gets lowered, there's more investment. There's more building into capital and other future productive resources. Question?
Yeah, so that pi represents profit in this function.
Yeah, thanks. Yeah, PR profits. Thank you. I love it when the nomenclature gets all wacky. And it always is. Sorry. Thanks for calling me out on that. Notice also from this expression, right, that in the steady state, profits will be zero. So then we would set marginal propensity to consume equal to this term, right? And that would determine everything in the steady state. What do we learn about from all of this? And what do you think about it? Again, this is trying to get at the micro foundations of the stuff that we do in the rest of the text. And here what we're trying to build in is, what is the decision about buying capital that's going to affect everything else? How do we decide that? How do we get investment? How do people think about investment? And there's different kinds of investment. There's investment in business, in fixed investment in business. So that's buying actual machines and stuff. Then there's residential investment. That's mostly buying houses. Either by people who want to live in the house or by a landlord who's going to rent that house out. And then there's inventory investment. Inventory investment is when you make some stuff and you haven't sold it yet. Most of the action though, like 70% of the action is investment by firms in capital equipment. So we get a capital rental market. And we're trying to understand the basic foundations of this capital investment. To sort of take a quick step backwards, we want to think about the rental price, the real rental price of capital. And we can graph this, capital stock. And in the short run, the amount of capital that exists in the world is fixed. So then what price will be paid for capital? Well, it depends upon the demand for capital. And the demand for capital is the marginal productivity of capital. In other words, you're not going to buy a machine to make some stuff unless the productivity of that machine generates output that earns you revenues high enough to justify the ownership of that machine. But you will continue to buy machines so long as an additional machine gets you some additional profit. So the rental price has to do with the marginal productivity of that capital. And if supply is fixed, at least in the short run, we identify the rental price of capital. It'll move towards that equilibrium. Well, what happens if there's an earthquake, Snow? Or what happens if a bunch of capital gets bombed? Then the supply of capital decreases. What happens if the supply of capital decreases? Well, the price of the capital that remains will go up because it'll be the quantity of the demand for it will push the price of it up. People will bid the price of it up. In the short run, right? In the short run, there's a shortage of capital. But those who want to use that capital will bid the price up until the highest value use of that capital obtains, as it does in any other market. Oh, wow. Got ahead of myself here. This is R over P. But in the final version of this model, we're not going to be talking about the capital stock or the rental price of capital. What we really want to do is have something that is articulated in terms of the interest rate and the amount of investment that's occurring. And I drew this a couple of seconds ago, but it looks something like this. There's demand for investment. What happens if the interest rate falls? We said if the interest rate falls, we'll see more investment. Okay, good. What would cause the entire investment curve to shift? What would cause the investment curve to shift? Anything that's exogenous or that's not either I or R. So what if the marginal productivity of capital increases? What if the average unit of capital? So you're buying capital, right? What if at a certain price of capital, if there's a new machine that costs the same price to buy that machine, but it's twice as productive as before? If there's a new kind of capital asset out there that you can buy that's gonna make you more productive, then you're gonna invest more, even if the interest rate stays the same. If there are investment opportunities that are better than there have been in the past, then that will cause a shift in the entire curve for investment. It's an exogenous shock. It's not either the interest rate or investment. It has something to do with the marginal propensity or marginal productivity of capital. What if we tax corporate profits? How's that going to affect the decision about how much to invest? Well, an increase in corporate taxes is like increasing the rental price of capital. So that will reduce, for any given interest rate, right, the amount of investment that occurs. It sort of is shooting yourself in the foot to increase corporate taxes. When President Trump was in office, he massively reduced corporate taxes, which can help to explain some of the boom in the stock market since then. Right? Why? Because the rental price of capital effectively became lower, so the amount of corporate investment that occurred massively increased. And so then corporate profits also increased as well. There's a few other like minor points that come up in this chapter. We're going to need a little bit more background to get into the rest of these. But because investment is so important to the way that the economy grows and so sensitive to intervention by the government, we understand that the share prices of corporate firms reflect the profitability of those firms to some extent. And so the stock market is therefore a pretty good indicator of economic activity, of real economic behavior or productivity. It's not perfect. Sometimes it lags, sometimes it's ahead of time, sometimes crazy stuff happens in financial markets that isn't really related to the real world. The quote in the text is one that I've heard many times before from Paul Samuelson, or the Robert Samuelson, I'm not sure. It said that the stock market has correctly predicted 9 out of the last 5 recessions. That's over prediction, right? So that's the joke about all of that. Okay. I have 5 minutes to talk about chapter 6. That should pretty much cover it. Probably get to everything that fast. Before I do, this is challenging stuff. I need to explain it better. Right? You got to read the chapter to get into it, but if you come with questions about it, I can walk through those. Have you all completed? You must have all completed the homework. Well, maybe not. So on Saturday we have homework due related to chapters 5 and 7. Is that right? How many of you have completed those assignments at this point? Okay. Total time it took you to finish them?
Definitely less than last week, probably more closer to like the first or second week of.
So like an hour and a half?
Yeah.
Yeah.
That sounds about right.
Okay. And how much referring back to the textbook in order to find formulas do you have to do?
I used like all kinds of websites. The textbook for me is a little bit confusing and not helpful, so I'll watch YouTube videos or something.
Okay. I hear you. Other feedback? Once you're done, do you understand the concepts pretty well? Yeah. Crap. This is still a work in progress, folks. I'm still making progress on it myself. I can tell you without a doubt that it's very different than it used to be. So you know that firsthand. But we'll continue to make progress. Okay, I'm not gonna do the agenda, but you want to do it. Thanks.
Wow.